Hey guys, today we're going to be talking about the fever of shareholder focused companies. Let's go. Um, let's start with the summary. The summary says that customer centric companies are better than shareholder centric companies. The second topic is that all stock picks have an implicit trust deposit in the capital allocators. So you have to analyze those capital allocators well. The third and final summary point is that compensation plans tied to stock prices are a risk, even for customer centric companies. Shareholder focused initiatives may sound appealing to us, stock pickers, because after all, they are claiming that they are going to give us returns in some way. But is it really? When we invest, we want returns. When we invest for the long term, we want sustained returns. Companies that want to satisfy the shareholder more than the customer are bound to lose sustainability because satisfying the shareholder doesn't bring in future revenue. The only exception to this is possibly a company that needs to raise share capital, and if they need so, they have to allude to shareholder returns to increase share prices. I mean, they don't have to, but it's a possibility. Um, some claim that Tesla may want Elon Musk may be pumping share price so he can raise more capital, and that's an example because those people that say that they say that in the event that Elon Musk can't raise capital from shares, he will not be able to make the investments and the returns that he's claiming that he will do. Let's start with Facebook's shareholder focused approach. Facebook's 2020 10K doesn't even mention the word shareholder. It mentions the word stockholder 76 times, but not in any meaningful way. Um, no shareholder focus at all. The shareholder proposals put this in words very clearly. And if you go to the F14A of Facebook's 2020, um, you can do that in the Security Exchange Commission. You'll see the document, and it says that Facebook's 10K describes the risk of the current share system. Mr. Zuckerberg is entitled to vote his shares in his own interests, which may not be always in the interests of our stockholders generally. So, what this proposal is saying is talking about dual class structure. It's saying that Mark Zuckerberg has a controlling stake in the company, despite of only having a fraction of that in financial stake. Um, but in reality, this sentence makes my mouth water because a company that lives for its customers is on the best possible path to sustainability and profitability because customers are the sole reason that this company exists, anyways, and exists and persists. Here's what it also says in the DEF 14A of Facebook's 2020 document. If we focus on this mission and build useful and engaging products and services, we believe we will create the most value for our shareholders over the long term. We did not seek to benchmark our executive compensation to any preset target percentile of the competitive market. Rather, the Compensation, Nominating and Governance Committee sought to compensate our executive officers at a level that would allow us to successfully recruit and retain the best possible talent for our executive team. And this is what I strive to encounter. But because they are very customer focused, and that shows even in the compensation plan. But of course, there is a caveat. The caveat is that The compensation plan is not clear at all, so we don't know the targets, and this this makes it seem like Mark Zuckerberg pays the executives and the board however he desires. So this has a lot of trust implied in him, and if he wants, he can easily screw up the compensation at will without any external permission. So if you are going to invest in Facebook, or if you already are, the thing you have to ask is, do you trust, or do I trust Mark Zuckerberg to do what's best for the company? You also have Alphabet. Let's see. Let's take a look at if they are shareholder focused or not. Although the Alphabet 2020 10K doesn't talk about compensation, 100% of their performance compensation plan is dependent on it. Um, and if you check the written post at stockpickinginsights.com, you will see an image taken from the DEF14A document of the 2019's full year document. And you will see the payout curve, or the variable pay component of the executives of Alphabet. You will see that this is solely based on one metric, and it is the outperformance of Alphabet stock versus the S&P 100 index. And if they outperform at least 25% of the companies in that index, um, the executives get the 50% of the performance stock units, which is stock basically. 50% of the target stock. If they outperform 50% of the companies, they get 100% of the stock. And if they outperform 75% or more, they get the maximum reward, which is 200% of the base PSU target, or in other words, the base stock compensation that they strive to get. So this is a 100% different approach from Facebook, because as we've seen, Facebook doesn't tie compensation to stock prices, and Alphabet does the exact opposite. The compensation plan is purely base salary and variable pay, and that variable pay is 100% linked to stock price. Um, a little quote from that document too. It says, based on the total shareholder return (TSR) performance of Alphabet relative to the companies comprising the S&P 100 over a 2021 to 2023 performance period. So this is the way that they compensate the executive. Alphabet pays executives and directors heavily with stock. It's not the best compensation metric, because a shower of share buybacks will pump the stock in short term without any real value creation. Um, and by saying this, I'm assuming that usually the stock price is above the intrinsic value, which is not always true, but I like to err on the conservative side. Um, and my point here is that buying back stock may pump the stock in the short term, and it may bring value to shareholders if they are buying below intrinsic value, but it doesn't do anything for the consumers. So the consumers don't care if Alphabet buys back stock or not. They only care if the products are and services are good or not. And that's where I want the companies I own to be focused on. The best metrics are arguably business related KPIs. For example, for a clothing company, we would like to see compensation tied to like for like sales. For a search engine, it could be how fast the user gets the answer to the queried question. So you type an answer, yeah, a question in Google, and because you want to get an answer to something, and how fast you can get that answer would be a good KPI to measure. For an entertainment social media platform, and I'm talking about, for example, YouTube or Instagram stories or YouTube Shorts, it may be user time spent per day, because if the target is to entertain, uh, a person that is engaged with that app or platform or website um, will be more engaged. Metrics that don't focus on the customer equal to higher risk of long-term unsustainability. For example, stock prices. Stock price outperformance compensation plans tip the scale more to the shareholders than to the customers. So they are not the worst, but they are definitely not the best. And uh, one thing is for sure is that stock investing always requires trust in the capital allocator, unless you have a controlling stake. And it doesn't matter if it's Mark Zuckerberg with his freewheeling variable pay targets, or Alphabet with their total shareholder return outperformance. Bad or non-existent compensation metrics increase risk. Um, what I mean by this is that um, you have to pick your poison, because either if it's Mark Zuckerberg if you have to trust Mark Zuckerberg to pay his executives well, so to get the incentives right and to make them build better products for the customers. Either if it's that, or either if it's an Alphabet that pays based on stock price, and stock price can be pumped for the short term by the executives, these aligning incentives. You have to trust both of them. So it it's a crucial part of the investing part in both, and both have completely different compensation plans. To end, a customer centric approach is way better than a shareholder focused approach. To measure the management's behavior, we must look at capital allocation and incentives. Facebook, Mark Zuckerberg, promises to reward product creation and talent without any guidelines, um, it, which is consumer centric but requires a lot of trust, because we've already talked about it. Alphabet rewards stock ownership, so they have a different approach, and so does, for example, Amazon. And here's a little quote from Amazon's the F14A of 2017. It says that, as a result, we believe that the best performance measure for our company is stock price performance over the long term. Therefore, when we set our executives' target compensation, we assume a fixed annual increase in the stock price, so that our executives' compensation will be negatively impacted if our stock price is flat or declines, and is favorably impacted if the stock price performs beyond the initial stock price assumption. So, um, what Jeff is saying is that, I don't know if it's Jeff actually, but what Amazon is saying that is that they set a target for price. If it goes up above that, they pay more. If it goes less than that, they pay less. And we already know, because we already talked about Alphabet. Um, it's easy to play with that stock price, because they can pump it with buybacks, for example. And um, Amazon is arguably the most customer focused company, and they also tie performance to stock prices. Both Amazon and Alphabet are customer centric, and we can see that in the great products they provide and constantly update, that they are customer centric. So, despite this, let's not be naive, because compensating with stock prices is a risk, and it doesn't necessarily align incentives with uh, with shareholders and customers. It doesn't align the incentives with customers, because um, because the customers don't care about stock prices, and it doesn't necessarily align incentives with shareholders because a 20-year shareholder of a company doesn't care about the stock prices on a short term basis, and buybacks pump stock prices short term. So I'll leave you with a few action points for you to take action on this information. And the first question is the compensation plan of my companies aligned with its customers? Careful, customers, not shareholders. The second one is, if not, am I accounting for that risk in the buying price? And the third and final one is, are the executives customer centric? And that's the last question. So if you like the content, please go to the website stockpickinginsights.com and subscribe. Put your email and subscribe, and we'll see you next week.